Today we're going to talk about hammer clauses and why you should try and avoid one. For contractors in New York, a lot of terms get thrown around. Hammer clause is one of those terms. You really need to be familiar with it, especially if you subcontract work. The reason being, a hammer clause can be extremely costly to your business. Basically, a hammer clause is an exclusionary form added to your policy to restrict or eliminate coverage based on the insurance coverage of the subcontractors you hire. I know that kind of sounded like word jumble, but basically, the insurance companies are tired of paying for claims regarding your subcontractors because they have junk insurance coverage. That's why a hammer clause is often called a sub-warranty. Now here's the thing. Having a hammer clause, while it isn't ideal, there are ways to work around it so it's not completely detrimental to your business. But if you're a general contractor, it does put all the responsibility on you to make sure your subcontractors have the right insurance. Typically, the right insurance has to do with having an action over exclusion. Action over coverage is another term that gets frequently tossed around, but don't worry, we're going to do a separate video to explain that. As I said, hammer clauses can be problematic, not only because it restricts or eliminates coverage if your subs don't have the good coverage, but also some general contractors won't hire you if your policy has a hammer clause. Oftentimes though, that general contractor will waive that requirement and allow you to work even with the hammer clause if you don't hire any subcontractors and you perform all the work yourself with direct labor. All this to say, having a hammer clause does not mean a policy is totally worthless or it's not worth considering. For example, if you're a direct labor only contractor and you never hire subcontractors, it might be worth considering a policy with a hammer clause to get some additional premium savings. However, as we all know, very few contractors never hire subcontractors. So then you're back to making sure your subs have good coverage. But even if you do hire subcontractors, it can still be worth it to consider a policy with a hammer clause if you're careful. The reason being, hammer clause policies generally start at a lower price point. Additionally, if you're a new venture, your options are pretty limited when it comes to coverage, especially good coverage. And more than likely, your policy is going to have a hammer clause until you've proven that your business maintains good practices for risk transfer. I always recommend a policy without a hammer clause, but sometimes it's just not available. Does your policy have a hammer clause? Not sure? If you're interested in talking about this further, reach out.